Efficient portfolio. Efficient portfolio is an interesting topic in finance and also the foundation for several other important areas such as capital market line, security market line, capital asset pricing model. Okay, and in this video I'm going to provide you some intuitions behind the efficient portfolio and also how to make the frontier line. The video including the PowerPoint and Excel files are also available in my blog at www.banksandmarkets.wordpress.com. Simply click inside finance and you'll get it there. Okay, now what is it? The efficient portfolio line basically provides an investor the portfolio with the minimum variance or least risk portfolio. It also provides the highest expected return for any given level of variance. Now look at this chart here. Look at this chart here. What we can see from this chart is historically investment in government-owned, government-issued securities such as the bonds and the bills have remained a lot more safer than investment in stocks. But the returns from these government-issued securities are not that attractive. I have the real data here that I can present. So basically what we are saying here is if I were to invest £1 79 years ago, in 1925 basically, then after 79 years time, the £1 invested in stocks will be 2,333, but £1 invested in bills will only be £19.43. So investing in stocks is really very attractive as compared to investment in the government issued securities. But there are also volatilities, high level of risk, as you can see the negative returns here, yeah, as high as 43%. So what we want to do is how to invest in stocks but yet minimize our risk. And what we can do, and this is where the role of efficient frontier portfolio, efficient portfolio frontier plays in. Okay, what we can do is invest in more than one asset, and if possible in those assets that do not move together, as this helps in diversifying the risk. To understand better, let's look at this table here. Okay, there are two tables. The table on the top, individual investment, and these are the return from the investment in the stocks of each of these stocks, yeah, and that's the volatility. But when you combine the investment, when you make the portfolio of these two, here is your return, and again when you make the portfolio for these two, the Western and Texel, that is the return. And you can see that the volatility has gone down quite substantially. What does this tell you? This demonstrates that by combining stocks into a portfolio, we reduce risk through diversification because the prices of the stocks do not move identically. Some of the risk is averaged out in portfolio. Okay? As a result, both portfolios here have lower risk than the individual stocks return. As we are talking about reducing the risk, you can also think it in terms of hedging, similar to minimizing risk of a ball going inside the goalpost so the opponents will line up when there is a free kick given. It is like you have reduced or hedged the risk through combination of stocks that are not moving together. Alright, now we were talking about stock and bonds, yeah? So let us use that. So if we say that we invest all our money in the bond, then that is our return, yeah? And the risk is here. If we invest all our money in stocks, then the return is higher. Of course, the risk is higher as well. But if we make a portfolio of the bond and the stocks, then You are somewhere here, yeah? Then what will happen when you are in this line, not at the extreme points? Then what will happen is you will be able to minimize the risk. For example, when you are here, yeah, you will minimize the risk or maximize your profit, yeah? Now, what you can also see here is at this level of risk, which is here, let's say 35, then if you do not combine your investment, then that is your return. But when you combine, then you can earn as high as here, yeah? And this is called efficient portfolio frontier line. That is the line, yeah? Efficient portfolio line. Now we want to know how to make this line, yeah? Basically, I'm going to demonstrate to you the case of two stocks, so Lloyd's and Glaxo. I've downloaded the share price, then I found the return, and then for these return data I found the mean, standard deviation, the variance, the covariance, and now here what I basically need is just the two items, which is risk and the return. The calculation of expected return is easy because it is just the weighted average of the investment in Lloyd's and Glaxo, yeah? And that's the formula. To find out the risk, which is standard deviation, I just need to do the square root of the variance, yeah? And variance can be calculated using the formula in the red, okay? And what you need to understand is the covariance of the x with x is basically the variance. If you are fine with this, then you can apply the same for covariance of return of the portfolio with the same stock will be equal to the variance of the return of the portfolio. And therefore what you can say is you can have this for our two asset portfolio, and using the algebra you will get this on the red. So you need to add these three elements to get the variance, and this is what I have already done here. So the task that I'm left with is just to copy it and paste it all the way down. And if I do that, then I should get my efficient portfolio frontier curve. Well, that is it. That is the curve that I wanted. Alright, now what I also want to say is, where is my minimum risk, minimum variance portfolios? To do that, I will ask the computer to help me, and if I click the solver function, then I can do it, okay? But before that, what I need to do is copy this, put it down, and over here is the place where I want to create the minimum variance portfolio. I'll ask the solver to do it for me, and that's D30. That is what I want minimum by changing this B30. And if I press click, then okay, then that basically means 42% investment in Lloyd's and 58% investment in Glaxo will give me my minimum variance portfolio, which is here. Now very quickly, we may like to know about this. This is the envelope. On the envelope and inside the envelope is feasible, is what we can achieve. But outside the envelope is infeasible. The one in the red is inefficient. The one in the blue is efficient. The one in the red is inefficient because at any point here, for that given level of risk, we can earn a higher level of return. For example, when you are here, let's say that 30 is your standard deviation, but at 30 standard deviation, you can earn as high as here, okay, 0.40% of return. The reading materials are available here. Thank you very much for your time watching and listening this video. Thank you.